Joining us now, the analyst behind that call, Piper Sandler Managing Director Scott Siefers. Scott, it's great to catch up with you on this. I know you've been focused this week in particular on just the equity market trading dynamics that seem to be driving the narrative in regional banks. You're saying that essentially a lot of the dislocations in the stocks are really no longer really tethered to the underlying fundamentals?
That's right. Thanks for having me, Mike. So, yeah, the volatility in the space just hasn't calmed down the way that we had hoped it would have a few weeks ago. And what really changed over the last several days is sort of this unhinging of fundamentals from reality. It seems, generally speaking, when we talk to our banks, that there's not the same kind of panic or agitation among customers that there was in early to mid-March. So it's more or less business as usual, and deposit trends industry-wide have kind of stabilized. So our thinking is just that we've kind of unhinged a little more than we would have hoped, and within the rubble of all this sort of bloodletting, we've really just let some really good names go by the wayside, and we think there are long-term opportunities for patient investors to pick up some good names.
That being said, the three that you have highlighted today, Fifth Third, JPM, and U.S. Bancorp, are really not the ones that have been most blasted in terms of the stock market reactions. They're not trading at the most massive discounts to tangible book value. So essentially, you're still migrating toward, I guess, a little more quality representatives of the sector.
Oh, undoubtedly. So first with JP Morgan, I mean, that's just sort of an ironclad safety name. So we tried to give a little bit of an optionality to investors. That's a name that has held up well, and we continue to think will be a real winner from this space. By contrast, however, a couple of these other names, even though they haven't been the real pressure points like we've seen in some specific names, they are down quite a bit. USB is down about a third since all this turmoil started in early to mid-March. So, great name historically, very good risk profile, very good earnings and revenue stream over time, maybe dealing with or contending with the same sort of capital questions that you'll have probably throughout the space as new regulation comes into play. But as long as they're given time, this should be a really good story and a good chance to pick up a very strong name over time.
How do you factor in new regulation and perhaps the forced capital raise or forced, trying to bolster liquidity, especially when it comes to U.S. Bancorp?
Yeah,
do you have a sense of what that additional, capital requirement would be?
Yeah, so great question, Melissa, because I think we're all trying to contend with that for the industry at large. But U.S. Bank's a little unique in that it had done a big deal right prior to, or just prior to, the onset of all this turmoil. And as a condition for that approval, they actually made an agreement with regulators that they would move up to, or be ready to move up to, a new stratification for regulation by the end of, say, 2024. So USB actually has about a 6-month lead on everybody else out there in rebuilding its capital. I think what you'll see is they'll probably add, call it 25 basis points or so a quarter to their regulatory capital ratios over each of the next several quarters and get where they need to be, certainly in time. So I don't think we're going to see necessarily forced capital raises. I think what you'll see is sort of a pause on repurchase, a lot of internal capital building. So, we'll husband a lot of our earnings. We'll probably pause share repurchase, and we'll be really diligent on what happens with balance sheet growth just to try to keep the denominator in check as well.